Está con nosotros Matt Siddle, gestor del Fondo European Larger Companies. Good morning.
Morning.
Given the recent fluctuation in the global markets, how do you assess the current volatility? And what do you consider to be the key factors driving it?
Yeah, I mean, clearly last year was a very volatile year with the war and the spike in inflation. Market's been less volatile this year, and if you were to look at indicators like the VIX, the volatility index, that's actually quite low. There's been much less volatility this year. But it's clear that the pace of interest rate rises, inflation is a big driver. And when you've seen such fast interest rate rises and a big interest rate cycle, that has tended to lead to higher volatility, but there's a lag. So, there's clearly the potential for more volatility, even if right now there's not so much. And it's really interest rates that are driving that and the tightening policy and the impact that could have on the economy.
Every investor are looking for the central banks, and today, Federal Reserve, they need to take forecasts for the economy. What's your point of view of the outlook for interest rate in the short and the medium term, and what's the potential impact in financial markets and investors?
Yeah, so I think both the Fed and other central banks like the ECB, Bank of England, they've started to indicate that we're getting towards the end of the rate hiking cycle. I think the Fed for the first time said that, specifically that rates are at a restrictive level now, and inflation is coming down, with some ups and downs, but the direction, the trend is downward now. So I don't know if we're at the end of a rate cycle. There could be one more, two more rate hikes to go, but I think we're in the late stages of it, definitely. And that's because, as I said earlier, there is a lag impact. You raise rates and the impact on the economy isn't tomorrow. The impact is in a few months' time as people look for their new loan or think about their next big purchase. And you are starting to see, as I think some of the ECB members said, you are starting to see the impact of these rate rises starting to show up in slightly slower growth and some of the data that you're seeing. So I think we're late in the rate cycle. There may be a little more to go. And then what happens in the medium term, that very much depends on how big that impact is. How big is the impact of that rate cycle on the economy? If it does tip into more of a recession, then we're likely to see rates falling again at some point next year, maybe in 2025. If this is more of a soft landing, then rates are likely to be more stable. And too early to say right now, but clearly there is the risk of a recession, and that would lead to rate cuts if that happened.
What do you think about the duration and severity of this possible recession, and what's the key factors that the European Central Bank could activate to fight for?
Yeah, so historically, when you've had this much monetary tightening, when rates have gone up this fast, if you look at money supply figures, money supply is shrinking, which is a very rare, year on year it's down, and that's a very rare occurrence. In some measures, monetary policy is even tighter than in the financial crisis. When you've seen that sort of cycle, historically that has led to a recession. So there is a clear risk. It's not automatically going to happen. This cycle is different because of all of the impacts of COVID, the impacts on the supply chains, the amount of stimulus that's been had. So there are differences, but there is a clear risk of recession. That would likely, in timing terms, likely be 2024, possibly early 2025. And then the severity, the depth, that is very, very difficult to judge. I think the positive side is that the banks and most corporates are in stronger financial shape, have stronger balance sheets. So the risk of that sort of deep balance sheet recession, which we saw in the financial crisis, where people were at risk of going bankrupt, I think that is much less. The risk of a normal recession and a cutback in investment and spending, that is real, I think, that risk. Not a certainty, but it is a risk.
Do you think that we could walk through a stagflation scenario, and this is the worst scenario for European Central Bank?
Yeah, I mean, it's difficult because if you have stagflation, the natural way of stimulating the economy is for governments to spend a bit more and for central banks to cut rates, and both of those things stimulate the economy. If you have stagflation, it makes it a lot more difficult because, if you cut rates, you're also likely to push inflation up. So if you've got a recession and inflation at the same time, that is very tough. As you say. I think on the positive side, what we're seeing is generally inflation is starting to tick down, and particularly on the goods side of the economy. If you split the economy into goods and services, the goods side of the economy, products, TVs, cars, etc., you're starting to see inflation come down there, and producer price inflation's actually turned negative. So the risk of stagflation from that is much, much less, right? That is definitely improving. The service side of the economy, you're not seeing that same improvement in inflation yet. That's much more driven by wages and salaries. And because unemployment's low, you're still seeing good wage growth. Wages are going up at a decent clip. Now, for many people, that's very good news, right? Having higher wages is a good thing. But it does mean that service inflation stays higher as well. So that's the balance that the central bank's got to look at.
What strategies do you consider important for investors to manage this situation?
Yeah, I mean, inflation is a difficult one to manage. Over the long term, I think the answer is reasonably clear to my mind. Equities are a much, much better inflation hedge than bonds are. And you're getting, you can buy in Europe companies which have got a higher free cash flow yield than the yield you get on the bonds, even at these interest rates. And over time, that free cash flow is likely to grow, both through inflation and because over time the economy is likely to grow. Okay, so medium term, I think the answer is reasonably clear that equities are a very good place to hedge this situation. But there is a shorter term cycle, and in that shorter term cycle, equities in a recession do have more downside than bonds do. And that's the balance that investors have got to strike. How fearful are they of a short-term recession? And how much do they want to protect themselves against that? You can buy less volatile equities. Some businesses are less sensitive to a recession, and some of those are also very attractively valued. So there are opportunities out there, but that's my view. Mid-term equities are definitely the place to hedge. European equities much cheaper than US. In the short term, that balance between bonds and equities is a more difficult question.
Thank you very much, Siddle, for staying with us this morning. Good day, good business.
Thank you.